and welcome to this month's episode of Capital Markets View. Hey, Taron, how are you?
I'm doing well, Chris. How are you?
Good, I'm okay. For the first time in my life, I have planted tulips a few months ago, and they're beginning to show through.
Wow,
It's cool. It's
spring is on
it's
the way.
yeah, lockdown discovery. I can grow tulips.
That's good because I just killed a plant in my office, so at least one of us has a green thumb.
Yeah. Yeah, let's see if they actually bloom. Right. So let's go to the first slide. The Ellie rolling 12-month total returns. Now, I've been doing a lot of fiddling around with my pension recently, trying to reduce costs, blah, blah, blah. And of course, in Europe, we can't, as retail people, invest in loans the way you can in America. But imagine you're a CLO manager or somebody in a pension fund or insurance company buying into the loan market. That red bit is not nice, whereas a lot of stock markets carried on going up. So if you cross compare loans to equities, not a good story in that red bit.
No, but I mean, the reason I put this chart in is just because it shows that we have recovered when you look at the last 12 months rolling last 12 months return. So in February, we actually we were at the highest level of this measure since December 2019. So we really have recovered from that dip back in March of 2020, and if you look at the weighted average return of the weighted average bid of the ELLI, European Leveraged Loan Index, that's actually in the end of February finally above the pre-pandemic 2020 high. So it reached a high in January of 98.66, and we finally climbed above that at the end of February. So we've kind of gone through the pandemic sell-off, and we're back to where we were, almost where we were before, or back above. So yeah, so I think that's a good.
So I should have been glass half full rather than glass half empty. This
That's
is a
okay.
good
I
sign.
correct you.
Just
Um,
all that red stuff there.
yeah,
Okay.
and I think also just to make the point that there was a sell off towards the end of the month in terms of government bond yields, but the loan market was not as affected by that because it's primarily CLO driven, which is different investor dynamic, and a lot of the breaks on new deals, that's been well supported as well, and we've also seen some large BWICs, bids wanted in competition, for loans. So it's been a good secondary month in February and in
Okay.
January as well.
So let's pop on to the next slide, the leverage loan volumes, which, year to year, comparing this year with last year, not bad, pretty good actually.
Well, yeah, and last January was the third busiest January on record. So when we look at where we are year to date, like I think we're doing quite well because last January things were going gangbusters. Um, I actually think it's more dramatic when we look at the next slide, the quarter on
So
quarter.
the new issuance institutional volume deal by type.
Yeah.
Yeah. Okay.
So
Yes.
keeping in mind, we actually aren't at the end of the quarter. So this, I updated the data through March 5th. So, and we don't have a huge pipeline for the rest of March, but we will obviously be higher than we were on March 5th. So when you look at the first quarter compared to the last few quarters, it does look like we've had a bit of a revival in terms of issuance, and also an increase in sort of all the different types of issuance. So refinancings, opportunistics, as well as buyouts.
Yeah. No, I mean, when I looked at this slide, actually, I'm glad you've given your interpretation of it, because the first time I looked at this slide, I just thought, wow, look at the amount of refis, recaps, and other things that are going on there. And the theme we had last month was an increase in refis and repricings. But actually, you know what? If you look at that slide over the past year or two, yeah, not actually hugely out of kilter. But like you said, the main point is the volumes, which is pretty
Yeah,
good.
yeah,
It's a
exactly.
good story. Yeah, really good story. But if we go to the next slide, which is CLO issuance, this I think does show a very, very different picture, because those three, I mean, big issuance,
Mhm.
which is great. but also a lot of resets and a lot of refis, which is of course because of pricing.
Yeah, and I was looking at this data last night, and actually, it's the largest volume of refis and resets in the 2.0 CLO 2.0 era. So it's and as you said, I mean, it's going to be because we did have that spike in pricing early last
Yeah.
year. So they're going to be taking it. Managers are going to be taking advantage of that.
Yeah, so I was talking to an arranger the other day, and he said he's super busy, and I can tell you in ratings we are super busy, but it's because you've got three elements, whereas previously there are only two. So you've got refis and resets that would naturally be occurring. You've got new issue, which has recovered and is now naturally recurring, and you have the wave of CLOs that were done at the height of, or the beginning of the pandemic last year,
Mhm.
coming out of the non-call period. So
Right,
you've got
exactly.
COVID CLOs, regular CLOs refinancing, and new CLOs coming out, which means it's the volumes are just as this shows, just amazing.
Yeah,
Um,
and
and sorry, carry on.
no, I was just going to also point out that we are still seeing when we go back to talking about just the new deals, we are closer to structures that we saw pre-pandemic. So we're getting closer to that sort of new 2-year non-call period, 4.5 reinvestment period. It's been 1.5 years on non-call and about 4.5 on the reinvestment period for the recent prints. But the average sizes are still marginally smaller. So on average, they're about 380 million euros versus 419 million pre-pandemic. So but it's getting a lot closer.
Yeah, and pretty good when you were considering that people at the beginning of the pandemic were literally kind of tipping warehouses straight into the market, and you were seeing deals at about 250. So yeah, pretty good actually.
Yeah,
Okay, let's have a look at the next slide, which is CLO WACC versus terminal brief bet, which is of course the arbitrage.
yeah.
And with AAA's coming down to 80 basis points, and loan pricing falling, but not falling, I think, as fast. Well, I don't know. Is that what this graph says? Do you think this graph means loan pricing is falling as fast as CLO liabilities?
Well, I mean, the arbitrage is still there, the excess spread. So the typical excess, we calculate it by looking at the weighted average cost of capital minus the term loan B single B pricing. So it's about 211 basis points. So that rule of thumb of 200 basis points, it's still over that. Now, your question about loan pricing, it does look like there's more capacity for loan pricing to come in. The next slide is actually on specifically loan
Okay.
pricing. So I guess we could look at that while we talk about this. So if you look at this, we're about 380 for spreads and 3.94% for yields. And it is the lowest since the first quarter of 2020, but it's still not lower. We're closer to sort of third quarter 2019 pricing. So potentially, with the fact that there is still so much demand in the market, we could see pricing come in further. So whether or not that arbitrage stays the same for CLOs, we'll have to see what happens with CLO pricing.
Yeah, yeah, because I mean, I still think loan pricing will come in more.
Mhm.
Um, uh, and of course, then on the CLO side, it depends on the demand. And if there are enough AAA investors and equity investors around to be able to cope with that. And you're right, the key is this 200 basis points arbitrage.
Yeah, and I mean,
And
if you look, I mean, Michael just published a CLO topical where he talked about a lot of these trends, and one of the things he mentioned is that investors are preferring higher ramp deals. So, like a lot of
yes,
the ramps are like 70%, which is high. So, we may see some of a slowdown in CLO issuance as they're trying to ramp up and get these better ramps because they're we need enough loan supply. And actually, if we look at the previous slide in our deck, which just shows the institutional market net supply versus CLO issuance, you can see that there has been more demand for assets than supply in the market. So that's what's driving pricing lower. we do need to see some more supply for CLOs to have assets to invest in.
So yeah, and actually, really interestingly, if you look at that net supply versus CLO issuance, you know, if you compare the loan market versus the CLO market, the CLO market's kind of been more go-go than the loan market. If I look at this net supply, CLO issuance, yeah, no, it's going to be. And then you said also, I remember you said earlier that there's not much of a flow. March is going to be a bit low when we come to look at the figures when we get to the end of the month for loans, relatively speaking.
Yeah, I think that's the case. We'll be looking at the final numbers next week and week after. I mean, we do have some big deals still to come, but yeah, it does seem to be slowing down a bit from January and February.
Yeah, okay. Right. So let's go to European high yield volumes. The first of those two slides about this. Deals dipping down a bit because that trend curve is down.
Yeah, so this is quarter to date. So this is actually through February 28th. So we still have a month to go. But actually, it is still a strong start to the year. The risk appetite has been, I mean, if you look at sort of that is comparing it to the end of last year, but there are no bars higher than that in recent history, and we will have more by the end of the month. Even with the sell-off in government bond yields, that softness sort of remains at the margins. There's still quite a lot of risk appetite. And we're also seeing pricing continue to fall for high yield bonds, which is the next.
Yeah, so let's slip to the next slide. Average new issue yields. And wow, the B pricing has really gone down.
Yeah, I mean, that's gone down 117 basis points since the end of the year. And I think we may have touched on this last time, but we have seen the ongoing use of secured bonds alongside leveraged loans because
Yes.
there were some instances this year, 6 in fact, where these bonds have priced tighter than the accompanying term loan Bs or FRNs. So although you don't really see it in the average pricing because we calculate pricing on a 3-month rolling basis in Europe, but there have been instances of pricing being tighter for bonds than loans. So yeah, continued demand for this asset class, same old story. Lots of liquidity in the market and demand for assets from those investors that maybe traditionally didn't invest in high yield bonds.
And also, quite interestingly, I was actually just reading an article this morning in the FT about inflation risks. And of course, buying a fixed rate instrument, if you think inflation is going to rise, is not great because you're fixed in. So it'll be interesting to see if that demand continues as people perceive greater inflation risks going forward. Although I guess people might just flip to FRNs, which are really just loans in another form. So cool. Okay. Yeah. No. Okay. Bonds. That's pretty impressive, actually. I have to say that is pretty impressive. Okay. Excellent. And our last slide. By the time this comes out, we will be heading into Easter. So, Taron, happy Easter.
Thank you. Happy Easter to you.
Thank you, and happy Easter to everybody who watches us regularly. As ever, any questions for Taron or me, please feel free to contact us. Thank you.